Welcome to Your Money Guides, brought to you by Interface Financial Planning. Hello. Today I want to talk to you about the importance of getting good investment performance on your pension. If you have monies in a pension or are looking to invest further sums in a pension, you will be subject to a future rate of return. Whatever you do, there will be a return on your money. This could be a good return, a poor return, or it could even be a negative return. So what do I mean by a return? This is a description of the rate of interest you will get if money is held in cash, or the annual investment return if your money is invested. Most people use risk investments in their pensions, and these will generate a return. You can't receive income from the investments, so the return you get from the money invested within your pension will be capital growth combined with the roll-up of any income. If your invested money performs badly, this return could be negative, implying a capital loss, not a capital growth. This guide aims to show you how important this factor is. I will outline some basic illustrations of how future returns can affect the eventual outcome, how much returns have varied from commonly used pension funds, and what you can do to give yourself the best chance of getting the best returns possible from whatever strategy you pursue. So just how much difference do future investment returns make? One aspect of a pension is, more often than not, is it represents a long-term investment, more so than just about any other investment most people will make. This is a very good thing, because it means there is plenty of time to A. Deal with the ups and downs in prices and values that inevitably occur with higher risk asset areas, which tend to perform best in a longer term, and B. To magnify the impact of extra annual returns. The effect of compounding returns is real and dynamic. Aiming to achieve the best compounding return you can get is a highly desirable objective for any pension investor. Taking this second point on board, this impact can be easily illustrated. Let us take two 40-year-olds who have pension funds of exactly the same value today, £40,000. They both have a fresh start with their investment approach starting today. One invests using a strategy which ultimately produces 3% per year. The other adopts a different strategy, and this produces 6% per year. How does this grow their £40,000 fund? By the age of 50, Investor 1, who's getting the 3% per year, their fund grows to £53,756, whereas Investor 2, with the 6% per year, their fund grows to £71,633. Now let's look at the difference at the age of 60. Investor 1, who's still getting the 3%, their fund grows to £72,244, and Investor 2 with the 6% per year, their fund grows to £128,285. And at the age of 70, Investor 1, their fund grows to £97,090, whereas Investor 2, their fund grows to £229,739. You will note that the longer time period stretches the difference quite markedly, emphasising the long-term value of the higher return. We can play with these types of comparison at will. The extra return always produces an ever-escalating gap between the two investors' future positions. So have I illustrated a widely optimistic future return? No. I've shown the difference between 3% and 6%, both levels which should be considered realistic. To highlight the trend here even further, let us look at the position of a 24-year-old saving £100 per month who will retire at the age of 67. At 3% per year, their projected future fund will grow to £89,700. At 6% per year, their projected future will be £113,000. Again, the difference is stark. This is all simple mathematics, a demonstration of differences that can be achieved by obtaining higher rates of growth. Remember, in the real world, these differences represent a difference to the future value of a fund of money that is yours. The prize for getting better returns is a big prize, one that has direct consequences to the amount of money you will have available in the future. So what makes the biggest difference, time or extra return? It's interesting to view just how much difference is made in generating returns if we view both time and returns in a separate fashion. To start with, let's look at three investors with £40,000 in their pension funds who have a 10-year time horizon. One of whom gets 3% per year, one gets 6% per year, and the other one gets 9% per year. Their future pension pot sizes after 10 years are Investor 1 has £53,756, Investor 2 has £71,634, and Investor 3 has £94,694. Even over a short period, the extra return starts to escalate and compound. However, it's time that makes the astonishing difference. Look at the same investors getting 3% and 6% over 30 years. Investor 1 will get £97,090, whereas Investor 2 with the 6% has £229,739. And what about over 40 years? Investor 1 with 3% would have £130,481, whereas Investor 2 with the 6% has £411,428. The compounding effect is amazing over time and accentuates the final figure. Many pension investors will say something along the lines of, "But I'm 50 and I don't have 30 to 40 years to invest." This is a fair point. However, even a 10-year period delivers a sizable difference if better returns can be found. Plus, many pension investors will continue to have their pension pots managed and invested well into their retirement years. The recent changes to how private pensions may be drawn at retirement, the pension freedoms, mean that many investors will draw on their pension pot slowly in stages throughout their retirement, leaving the undrawn part invested. This means a 50-year-old may still have an investment approach in place for another 20 or more years. So how about the real-world position? How have pension funds performed in the past, and what sort of differences in performance have occurred? I can now show you a snapshot picture of how pension funds have performed in different sectors over an historic 10-year period to demonstrate the wild fluctuations that occur and why, if you can find good funds with good performance, it will make a big difference. I will then show you how much difference this would make to a starting sum of £400,000 10 years ago. Investor 1 achieves top quartile returns, whereas Investor 2 will achieve bottom quartile returns. The conclusions are completely consistent with the exact same comparisons made in 2014 and 2015, and they were re-evaluated in 2018 with the same degree of fluctuation appearing. This shows a pattern which clearly shows that there are big differences between the top performing funds and the bottom performing funds. It should be noted that not all funds, even within the same sector, have the same level of risk. However, adjusting for risk metrics does not change the dynamic. Fluctuations in performance are rife, even where the risk rating is considered. The following figures from November 2016 are used to illustrate the sort of differentials that can exist and were taken from TrustNet. The first sector I'm going to look at is the UK smaller companies sector. This is a sector which contains funds where the fund manager invests into smaller companies in the UK. There are 44 funds we have tracked with an established 10-year performance. The average 10-year return was 111.4%. This is 7.6% per year. However, the average of the top quartile, i.e. the best 25%, was 10.3% per year approximately. The average for the bottom quartile, i.e. the worst 25%, was 4.5%. You can therefore see that over a relatively short period of time, 10 years, an investor who was in the average of the best funds would have gained around 5.8% per year more than an investor who was in the average of the worst funds. The top quartile investor would have £106,614, whereas the bottom quartile investor would have £62,119. On a £40,000 notional starting fund, this is around £44,500 more simply for choosing a better fund. Let's now look at the UK indexed linked gilts. This is a sector which contains funds where the fund manager invests into UK government index linked gilts. There are 57 funds which we have tracked with an established 10-year performance. The 10-year average return was 120%. This is just around 8.2% per year. However, the average of the top quartile is 9.3% and the average of the bottom quartile was 6.8%. You can again see over a relatively short period of time that the investor in the average best funds would have gained 2.5% more per year than the investor in the average of the worst funds. The top quartile investor would have £97,333, whereas the bottom quartile investor would have £77,228. Again, on a £40,000 notional starting fund, this is approximately £20,000 more simply for choosing a better fund. And finally, let's look at the flexible investment and managed sector. This is a sector which contains funds where the fund manager invests predominantly into equities, but with a split to include other assets, such as cash and gilts. This is the traditional managed fund that many pension investors use. There are 77 funds we have tracked with an established 10-year performance. The 10-year average return was 84%. This is 6.2% per year. The average of the top quartile was 7.6%, and the average of the bottom quartile was 4.3%. Again, over a relatively short period of time of 10 years, the investor who is in the average of the best funds would have gained around 3.3% per year more than the investor in the average of the worst funds. The top quartile investor would have £83,211, whereas the bottom quartile investor would have £60,940. Again, with the £40,000 notional starting fund, this is just over £22,000 more, for simply choosing the better fund. These examples, which are a sample from the fund market, demonstrate that even within sectors there are relatively large variations in performance from the top to the bottom. As I described earlier, these variations will create a sizable difference in pot value over time. An investor who can get the better return will have a far bigger pot at retirement than the investor who gets the lower return. Today, this is truly significant because the recent changes in pension rules for private pensions mean that from April 2015 onwards, pensions can be drawn in full at retirement subject to tax. They do not have to be turned into an annuity. Someone arriving at retirement with a pot of £100,000 because they have managed to get a better return than somebody else who has a pot of £70,000 can enjoy an extra £30,000 as a cash lump sum, less the appropriate tax. We have established therefore that returns compound quickly, and that even relatively small extra amounts soon start to add up, and that differences in returns exist within the fund market. This leads me on to how do we try to ensure that we get the best returns, and the importance of seeking help and advice. The government changes introduced in April 2015 provide greater freedom for pension investors with a private or personal style pension plan at the point they retire. In brief, these changes will allow pensions to be drawn without restriction, at a rate and a pace of income to suit that person's own requirements. This is an important change which invigorates pensions, making them incredibly flexible at their most important stage, the stage where they are needed to produce an income. However, this change should not mask what is most important to anyone saving into a pension and looking forward to their retirement. The amount of money that's in the pension will always be the most important factor. In this respect, this guide has been produced to highlight how much difference pension investors can make to their eventual retirement pot and income by focusing on the importance of the return generated year by year. There's a real, meaningful and discernible prize to be gained from concentrating on performance. Most modern pensions are keenly charged. In other words, they can be accessed with low or competitive charges, leaving the variations in performance as the likeliest biggest differentiator in how much money will be available in retirement. So how does a pension investor get better performance? The issue that remains therefore is this. It's clear that performance makes a big difference, that there are variations in performance in the fund market, and that two investors using similar strategies can and possibly will get very different results. So how can you set out to get the better performance? Clearly no one knows what the future returns will be from any sector or fund in the market. Likewise, there is no guarantee that a good past performance, including outperformance, will be maintained. This suggests that there is an element of chance around pursuing any mix of fund selection. This is true, but only to a point. There are ways to focus on better performance, and there are steps to improving the prospects of getting superior future returns. Naturally, these are not guaranteed, but these steps can be employed by anyone. They include ensuring that your asset allocation approach is based on your risk profile and tolerance, using detailed analysis of funds which extends beyond simple past performance assessment, ensuring that the funds you use are non-correlated and are diversified, undertaking a process of regular reviews to monitor and, where appropriate, change any non-performing funds, and to keep your approach current to changing fortunes. Also having a disciplined and structured approach and a plan of action which is focused on continually searching out the best funds. And finally, working with appropriate, qualified and quality professionals who will have experience in the selection of funds. The summary of this is a simple one. Improving performance or getting good performance is worth pursuing. It's unlikely to involve any significant increase in costs or charges. However, it will inevitably require more time and focus. The outcome, if you can achieve this, is a higher pension for you to enjoy in your retirement. Thank you for listening. For more information, visit our website at interfacefinancialplanning.co.uk.